Wednesday, February 15th, 2023, Monaco 64, home of alternative economics and contrarian views. We're going to look at how currency debasement will continue to wreak havoc on the general public, not just here in the UK, but all throughout the Western world and the rest of the world, really. But we're going to focus on the UK today. So today we've had the what's called the inflation data published by the ONS, Office of National Statistics, here in the UK. And really it's the CPI, which is the Consumer Price Index. It's not the inflation data. And before I go into it, I'd just like to say that inflation against government or without government is impossible, as Felix Sommery, one of the most reputable and influential bankers of the first half of the 1900s, once said. And I highly recommend his book if you can get it, The Raven of Zurich. So yeah, let's not forget that. The CPI and the RPI as well, which we'll look into, they don't cause inflation. They're the consequence of all the monetary recklessness of the Bank of England, cutting rates to zero for almost 15 years, doing, up to almost a trillion pounds of QE since the '08 crisis, and just over, I think about $500 billion since 2020. That's what causes prices to rise, because it leads to the increased supply of currency while the economy can't keep up, the real economy, and that's why prices rises. It's not because of Brexit or the war in Ukraine. Yes, those might have exacerbated things, but the underlying reason is money printing by the central bank and deficit spending by the government. Is it any wonder that government spending is above 50% of GDP? So back to the CPI data that came out today, and you have publications like the FT, which are a mouthpiece for the government and the Bank of England, the financial establishment. They come out and say UK inflation falls to 6-month low of 10.1%. Well, prices still rose by 10.1%. So how can what they consider inflation really fall? I think the headline should have been UK public still being punished with a rising cost of living, of double-digit cost of living. So yes, you're going to see a lot of this today in the mainstream press. They're going to focus on the fact that it dropped, that it's great. And with that, I'm going to come to RPI because I think it's very significant to look at RPI. RPI is the Retail Price Index. So as you can see here, the CPI came out today. It was expected to drop from 10.5 to 10.3, and it dropped to 10.1. Whoopee, right? We still have double-digit CPI. But interestingly, the RPI, which was what was used for inflation up until 1996, that remained unchanged at 13.4% year on year. So how different from the CPI is the RPI? So here it says RPI includes items that are removed from the CPI basket, including estate agent fees, mortgage interest payments, buildings insurance costs, and the cost of the TV license. It also removes the council tax, as you can see here. Council tax is included in the Retail Price Index, but not in the CPI. And then we go to an article from moneyweek.com. This was published in December 2022. It says CPI versus RPI inflation. What's the difference? we've been hearing a lot of about CPI. Well, they say CPI inflation. It's just CPI, I would say, recently. But what is this metric and why is it different from RPI inflation? I'm going to put a link to this article in the description of this video, and you can read the whole thing. But the most important one, distinction, I think, is this here. What is RPI inflation? It says RPI is the original consumer price inflation measure. In fact, from its first official publication in 1956 until 1996, when the CPI was introduced, RPI was the only measure of its kind available for the UK economy. So this is what they used in the 70s and 80s when we had very high inflation. And this part I highlighted it because I think it's really important. And it goes to the idea of financial repression of the general public. And I did a video recently about financial repression. I'm going to put it up in the cards so you know what financial repression really means. I'm not going to go through it right now. But it says the goal of RPI is to assess inflation faced by the typical household. To this extent, it excludes the top 4% of households by income, as well as pensioner households who get at least 75% of their income as benefits. So there you go. So why is the UK economy still not out of the woods? Why do I think the general public is still going to suffer from the current environment? And of course, the government is trying hard to say that they're going to have inflation in the next 12 months. Well, you know, they're going to have it from 10 to 5%. But what about RPI? Is that really going to be is that really going to help you? Probably not, because it'll still be 8 or 9 if they succeed, if these measures come down. And the other thing that worries me about the UK economy is the fact that gilt yields are starting to creep up again, as you can see here by the 2-year gilt yield and the 30-year gilt yield. Yes, this morning they have come off a little bit. I wouldn't be surprised if the Bank of England isn't there intervening in this market. Yields are down a little bit. The 2-year is down about 7 basis points. Is back below 380. But as you can see, yesterday it was breaking out. And why is that important? Well, I'll show you some articles here. This is Money Week article from yesterday. Banks pile back into mortgage market as choice loans rises after the mini budget crash, and the best fixes have rates of less than 4%. The number of products up to the highest level since August, says Money Facts. Fixed rate mortgages continue to fall amid a rates war with some sub 4% interest. Well, this market here, the mortgage market, they're coming back. They think that rates have topped. They think that inflation has topped, and they're pushing people to get back into the mortgage market, into buying properties. It could be a good time in that I think rates are going to go a lot higher, but beware, if you're fixing a big mortgage right now, it could be even higher in 2-3 years when you have to refinance it. I don't think rates are going to go back down. I don't think the Bank of England is right about their CPI or inflation going below the target of 2% next year. I think that's complete fantasy. So beware of the housing market. Beware of how much risk you take. This is, of course, not advice. This is something that I would be concerned about if I needed to get involved in the mortgage market, which thankfully I don't have to. Here's from Moneysaving Expert. Seems like it should be money borrowing expert, because there's very little about really you watch stuff on the internet. For example, I watch YouTube like all of you do, and a lot of the adverts are for loans, for credit cards, for mortgages, nothing about savings. But it says here, fixed mortgage deals expected to get cheaper despite base rate increasing to 4%. What you need to know. So I don't think so. I don't think mortgage rates are gonna get cheaper. I think they're gonna get more expensive, and I think the Bank of England is gonna be in a tough situation, and because prices are going to continue to rise. The gilt market is pointing to that. Maybe not today, but I wouldn't be surprised that by the end of the day, these rates are a lot higher. We're seeing like the 30-year approaching 4%, the 10-year approaching 3.5%. And the 2-year is important because they use that a lot, the 2-year gilt and swap yields for setting 2-year fixed deals and even the 5-year fixed deals. So yes, I wouldn't be too bullish about things right now. I would be cautious. And yes, the financial repression will continue. Inflation has not been mastered. The Bank of England rate is still, it's over 9% below the RPI, which means that they're paying you to borrow money if you are the average household. So monetary policy is still very loose. So for those of you who have been able to save, of course, you're going to continue to see the value of your savings, the purchasing power of your savings in the British pound continue to go down. Yes, the gold price has fallen quite significantly in the last few weeks, but I would say it's just another opportunity to get involved. And some of you have asked me, what gold should I buy? Well, you should just, if you have never done it, just go ahead and do it. Maybe buy a sovereign, or maybe buy a Britannia, depending on your circumstances. Should you buy gold bars? Well, why not if you want to? There's 1 gram gold bars, there's 5, 10, 20 grams, there's 50 gram bars, there's 1 ounce gold bars. But tax-wise, sovereigns and Britannias, they're coins of the realm, so they don't incur capital gains taxes. And we know that the capital gains thresholds are going to drop significantly this coming April and next April. By next April, the threshold where you don't pay capital gains tax is going to have dropped from 12,300 right now to, I think, 3,000. So I think having a little bit of gold outside the system is a very good thing. And I've spoken about how the banks are not as safe as we think. Your money is not your money in the bank. It's an unsecured loan to the bank. So I think it's more important than ever to consider having something outside the system. And yes, if you've never bought gold and silver, of course, I do have my partners, bullion dealers, and their details are below in the description. Gold investments would be really for my viewers in the UK, and the other two, ITM and Miles Franklin, would be for my North American viewers. So with that, let's quickly look at where the markets are this morning. It's 8:20 a.m. London time. So we've got gold down another $20 at 1834. The low's been 31, the high's been 60. I'm sure the Bank of England, with all the gold that it holds for other central banks, has been out leasing a lot of gold into the bullion market this morning. And what does that mean? Well, they want the Barclays, the Lloyds, HSBCs of the world to sell gold in order to keep the pound from looking too much of a pig, so to speak, because the pound today is down as well, almost 1%. It's down 0.75%, because really they don't have control of the bond market. They don't have control of inflation. But all it does, it gives you a better opportunity to, I would say, stack. And that's just my opinion, of course. Silver is down 30 cents or just over 1% at 21.50. The Dow future is down 145. The NASDAQ future is down 78, and the S&P is down 21. The FTSE is down 32 points at 79.33. To the currencies, as I said, sterling is down 94 pips or 0.75% at 120.77. The euro is down 0.25% at 107.11. And the dollars continue to rise against the yen. It's up about 0.2 at 133.33. And to the other currencies right now, let's have a look at Aussie dollar. Aussie dollar is down 1%, 69.04. The dollar's up 0.4 versus the Canadian dollar, 133.90. And the Kiwi dollar is down almost 1% at 62.80. Platinum is down $8 at around $9.25. We've got WTI crude down 1.2% at 78.25. Brent crude is down just over 1% at 84.40. And high-grade copper is down just over 1% at 4.04. So it looks like the commodities, general commodities, and the precious metals are taking a little bit of a hit here this morning. All assets, really, stock markets. And with that, let's quickly look at the bond market. And yeah, the Japanese bond market looks very stable for now, but I think underneath the surface, there are some problems there in that market right now. The 10-year yield is steady at 0.5%, which is like the top target for their yield curve control. The 10-year yield is down. Well, actually, is unchanged at 3.75 U.S. 10-year, and the gilt market, as I said, has had a bit of a relief rally this morning. I'm not sure why. Maybe the people in the city of London buy into that FT headline that inflation has come down, and it's at only 10.1%. But we'll keep a close eye on the gilt market, and I think we're not out of the woods, as I said, and unfortunately, the general public are going to continue to suffer because we're going to continue to see financial repression. So with that, I'm going to wish you all a very good day. Take care. Bye.